I thought Hood versus HOOY would be a close matchup, but the deeper I dug, the more the data surprised me. Let me show you what I found. Today we're comparing HOOD with HOOY the right way. Total return, volatility, growth drivers, and real investment outcomes. I've built a full spreadsheet that lays everything out clearly so you can see exactly how these two stack up. No hype, just data. So let's dive in. Welcome back to Simply Money. Before you buy either of these ETFs, watch how these two stack up. Let's pull up the spreadsheet. For those who are new to the channel, what we do on these comparisons is we have a hypothetical $50,000 investment, and we show how many shares we get of each one, and then the different scenarios. We use two scenarios. One is if we do 100% drip. So with both funds, we're getting whatever dividends they pay, we're buying more of the same share, building and letting that compound. The second scenario is we do no drip, and we'll get into that here in a moment and how that works. Let's start by showing the data here. May 5th, 2025 is when we're starting. We have to start with the latest fund at its inception. So HOOY started in May of 2025. That's where we're starting the data with Hood as well. Hood in May of 2025 was sitting right at $48.05. It was able to buy us 1,040.58 shares. As you can see going down the share column here, that never increases because Hood does not pay any kind of dividend. There won't be any reinvestment at all. The only thing we have here to look at is the share price return. And it has done really well. For those who have followed it, for those who own it, you've seen how well your portfolio has done with this fund. Looking through this, going down column B here, you can see the share price and how it's fluctuated a little bit, but it's been a pretty steady climb up for this year. As we get down here to the bottom, December 1st, 2025, the latest data we have on this, it is sitting at $123.24. As we get down to the bottom here, you can see the last input I had was December 1st. Look right before that. In November, it got down to 114. Now it's starting to climb back up. November was a tough month for the stock market for a lot of funds. It went down, corrected a little bit. It was a slight pullback. And this happens constantly in the stock market. It's nothing new. It's nothing to be alarmed by. It pulled back a little bit. Different news cycles, things get nerves and investors changing their strategies. But you can see here in December, it climbed back to 123. And then as of the close of the market on December 5th, it was up to $131, almost $132. So from the beginning of May till now, it has had an increase in share price of 156%. That is a great return. Anybody who had bought into this in May and still holds it is probably very happy with the current return they have. It is down slightly from its peak, but nothing to be concerned about. Because we haven't changed how many shares we have, our value, our ending value as of December 1st is $128,000. Again, that'll be up slightly because the price has gone up a little bit more. But looking at this December 1st price, you can see that the gain is $78,241 that this fund has gained. That's a great return. $50,000 invested in May. Now in December, it has grown to $128,000, returning $78,000. You've more than doubled your money. 150% return in that short period of time. Now let's look over at HOOY. As you can see, the price there was $52.05, and that bought us 960.61 shares. Now with HOOY, for a while, it was paying monthly. So you get your distribution once a month, and then you'll see recently it has changed to paying weekly, and we'll see that distribution drop, but it's more frequent. We're going to see how that's impacted things. But let's look down. The share price is, again, because it's following Hood, has gone up at very little downsides, has gone up most of the time with a little bit of dip here and there. And we'll go down to the bottom, and we are ending at 53.43. Currently, it's sitting quite a bit below where it had peaked at about $76. We're hoping, obviously, those who own it. I do not own either of these, so this is just me sharing the data. And it's a good time to throw this in. This is not financial advice. This is just for educational, informational purposes only. You'll have to do your own due diligence. But looking at this, you can see that it is down a little bit. It is starting to bounce back as well, but it doesn't get all the upside. So we may lose some of that as we look at this. But one thing you can see is because these, let's go back up to the top here, these shares are gaining because you had 960 and then you got your first monthly distribution, paid $3.30, a $3,173 distribution that first month was able to buy you 54 more shares. Then you look down here in June, it paid $6.50, $6,600 payment. If you invested $50,000 within 2 months, you'd gotten almost $10,000 in distributions. Whether you reinvested those or took those, this we're looking at totally reinvesting it. So you bought almost 100 more shares. Then down here in July, you were able to get $6.90 per share. And just in those 2 distributions, you're able to add 150 more shares. So you're getting $6.90 on those 150 shares in addition to the ones you originally had. Your 1,112 shares total now brought in $7,676. So very nice return with the distributions. And we'll just continue to go down. You had a 4,700, 4,900, and then the largest here in October, even though this is slightly lower at 595 versus the 690, you've accumulated so many more shares, you got a payment of $8,115. And that's where the accumulation of shares can really impact. Even though the dividend, the distribution drops slightly, you're getting more in your distribution payment because of that quantity of shares. You're up to 1,364 at this point. Then you can see we go weekly. So you're getting smaller payments, but you're going to get them on a weekly basis. From here, you're seeing from October 20th, you're getting $1,000, $2,000, almost $2,000. Again, $1,400, $1,200, $1,100, $2,100. Since May, $46,000 have been distributed and reinvested and able to buy you almost 700 new shares of this fund if you're doing 100% reinvestment with those. And that's what this scenario shows. Now the balance, and this is where, because this share price has not catapulted like the underlying fund, it has lagged. You're getting most of your gain because of reinvesting that distribution. But still, if you took HOOY aside and you just put HOOY and you looked at the data, this is a nice return. $50,000 from May to December has grown to $88,000. And you're sitting there on 1,600 shares of this fund. And let's say at this time you wanted to turn that drip off. Now you have an $88,000 balance that's paying you around $1,000 to $2,000 per week with this. A great performance either way you look at it. And we can look at that. The drip, 100%. For HOOY, 156% return. For HOOY, almost 81% return. Both of those are fantastic. But bottom line is, HOOY outperformed almost by 2 times the amount in this short period of time. Again, this is a very short window that we're looking at, and we'll see how data down the road pans out, if it does better holding the underlying or the covered call HOOY. Now let's slide over to the no drip. This is where our scenario changes. Now with HOOY, because there is no distribution, what we have to do is we take the amount that HOOY is paying and we calculate how much we need to sell of HOOY to generate the same amount of money. Because if you're retired, if you're living off your investments, if you own HOOY, you don't get a distribution. So you have to sell shares. And so what we do is we calculate the amount that the HOOY is paying, and we sell the same amount of equal number of shares to get that dollar amount. And then we subtract those shares from the holding. And that gives you a comparison of, is it better to hold the underlying or to have the distributions, the yield that you're getting, and not have to sell any funds? And again, this is short period. This is a short time frame that we're looking at. So there's going to be some nuances as this progresses down the road. If we look at this again in a year and 2 years, we'll see a difference in some things that I want to try to point out here. But looking at the comparison, again, you have your drip here. You have your no drip here. So you're taking that $3,100 distribution and you're using it for your living, for your expenses. This is off a $50,000 investment, and you're getting a $3,100 payment for expenses for the month. That's not too bad. That's nice generation of income to help supplement your retirement. In order to do that, we had to sell. You can see we sold about 50 shares to get the same equivalent amount. So if you owned HOOD, you sold 50 shares to get $3,000 of income. And down here, we have $6,247 from HOOY. So we had to sell, again, shares. We sold about 67 shares, give or take there, to generate this amount of money. So as you can see, our share quantity is dropping. Now with HOOY, our shares are staying exactly where they were when we bought them at this $960.61. So it is staying exactly the same number of shares, and it is just drawing the distribution based on that number of shares. We'll go down here and we will see what's happening as we get into the weekly. Again, we had the monthly payments, monthly payment here in August, monthly payment in September. So we're selling shares of HOOD. We're collecting distribution from HOOY. And we'll come down here. Now we're at the weekly, and we're seeing the HOOY, this biggest payment here of $5,700. It's not as big as when you had the drip because you didn't gain more shares. So you can see how the larger amount was actually paid earlier because it's the 690 distribution on 960 shares, where this is the smaller distribution, but on the same number of shares, where over here, you had that larger payment because you had more shares. I hope that makes sense for those who are following along. So here we have our weekly payments begin. So now you're getting off this $50,000 because it's paying weekly. You're getting $700 this week, almost $1,300, $1,200, $885. So you can see this. There's a little bit of fluctuation in there. We have anywhere from $700 up to about $1,300 per week. Both of those are nice weekly paychecks off a $50,000 investment. But here's where we have to look at the difference. Let's go down a little further. You can see with HOOD, we have had to sell 325 shares. So now we're down to 714 shares. But our portfolio balance is still up $38,000. We're up to $88,000. So even though we're selling shares, we bought $50,000 worth of shares, got us, 1,040 shares. We've been selling them off to generate the income that's equal to the distribution of HOOY, and we're still up $38,000 on our portfolio. If we were to say, okay, I've generated some income for whatever reason you were using it, and now I want to sell out of this, you have fewer shares, but you still have a capital gain of $38,000. So it's a great unrealized gain currently as you own it, generating income. So you're generating income by selling off shares, but you're still increasing your portfolio balance. So it's a great return there. Now with HOOY, we've generated this almost $36,000 of income. And that's why we had to sell these 325 shares of HOOD to generate that same $36,000 of income. And our balance now is at $51,326. So we haven't had to sell any shares. So if this starts to bounce back, we have the same number of shares to gain that bounce back. Again, for a lot of people, they like that when they're using their income not to have to sell shares, because this is short term and we only saw a little bit of downturn in November. How would this fare in a bear market if you're selling off shares at a discount of HOOD? If HOOD drops 40, 50% and sustains that for 6 months, 12 months, 2 years, and it's dropping and dropping and you're selling more and more shares each time, what would your end balance be then? We don't know. We'll have to watch and we'll have to redo this again in maybe a year and see how it's fared through different market environments as the market shifts and changes. But bottom line is, again, one, what is most comfortable for you? Do you prefer, I want maximum return and I don't care if I sell shares and I'll use a bucket strategy to mitigate sequence of returns and in down markets not have to sell and have different strategies? This is a very static strategy where we're just saying we're selling no matter what, we're taking distribution no matter what. And so you're just comparing it side by side. But in real life, maybe you have a strategy where you're like, I want HOOD, I'm going to generate that return. But if the market's dropping and the share prices are down, maybe you set a benchmark. If it's below 10% from my value that I set, I'm not going to sell. And I'll draw income off of other assets. I'll draw income out of a bucket that I have for maybe savings or more steady, like bonds, whatever you're into. So you have different strategies that you can use, but here we're just, again, comparing what it would take to generate the same income as HOOY. And as you can see, once again, with no drip, HOOD total return outperforms HOOY. Down in the comments, what are your thoughts? Obviously, HOOD produces more, but what do you prefer? And what stage are you in? Are you in an accumulation stage? And that's where, personally, if I was in an accumulation stage, I would be like, I'm definitely buying into the underlying to maximize my return. And then I can shift into some income focus down the road. Or perhaps you're at a point where you're already retired or independent financially, and you're looking to just have income, and this is just a supplemental income. Here's a thought though. Leave me your thoughts down below, but here's a thought. Look here at HOOD. Let's just pretend in May you put in $50,000 and then it has grown to $128,000. So let's say you take that $50,000, you put it into HOOD, you let it grow, then you take $50,000 and put it over to HOOY to generate that income, but now you still have this $78,000 gain that you had in HOOD. So now in 7 months, you would have a $78,000 HOOD position and a $50,000 HOOY position, one continuing to grow, maximum growth, the other producing income where you don't have to sell off shares. Then periodically, when the market's really high, say HOOD has had a really good run, maybe you sell off a portion again and add to HOOY to give you more income, but keeping that base of how much you want in HOOD to help produce more income down the road. And that's what you can do with a lot of ETFs, having a base. Personally, I have SCHG as one of my biggest growth positions. And that'll be used to help as it grows to help fund other income producing assets, whether to give me a pay raise or to replenish if there's been some NAV decay in some areas, whatever the case might be. But I don't have to sell it to continue the income I have. If I see SCHG has grown tremendously, it's had a great bull run for a few years and it's very high, maybe I sell off a small portion and add to my income portfolio. And that's kind of a bucket strategy. You have your income and then you have your growth. And as growth is doing really well, you sell it off. But if you're in a bad sequence of returns, you let that growth sit so you're not selling it off at a discount. So that is how you can approach it. There's lots of different strategies. I recommend that you do due diligence, do your research. But what are your thoughts down below? Leave those for the community. I appreciate you joining me today. I appreciate you watching. Don't forget to share some other funds you'd like to see compared, and we'll see you next time on Simply Money.